Every candle on your chart is not just a random shape or a technical signal, it's a psychological footprint of the market, a direct reflection of how fear and greed battle in real time. To master trading, you have to learn to read this language of emotions that appears on your screen in the form of candlestick patterns, because every pattern reveals who's in control, the buyers or the sellers, and when that control is shifting. Most beginners only see green and red, thinking that a candle itself decides whether to buy or sell, but professionals know that context is everything. You must connect each candle with support, resistance, trend direction, and market structure before it becomes a high-probability setup. Let's decode the 7 most powerful candlestick patterns and understand the psychology behind each one. The bullish rejection candle, for instance, shows a fight where sellers pushed the price down but buyers returned with force, closing the candle higher and signaling potential reversal from a support zone. It's the moment when buyers say enough and regain dominance. The bearish rejection candle is the mirror image. Buyers tried to push up, but sellers overpowered them and closed the candle near its low, revealing exhaustion at a resistance. The morning star and evening star patterns go deeper. They tell stories of exhaustion and rebirth across 3 candles. A morning star begins with a big red candle representing panic and fear, followed by a small indecision candle showing that selling pressure is fading, and finally a strong green candle that signals bear confidence and a possible trend reversal from a key demand zone. The evening star reverses that story, forming at the top when optimism peaks, greed dominates, and smart money quietly begins to sell into strength. Then comes the bullish engulfing pattern, a dramatic shift where a large green candle completely covers a previous red one, symbolizing that buyers have erased all losses from the prior session. When this happens at strong support or after a pullback in an uptrend, it means institutional buying might be entering the market. The bearish engulfing is the exact opposite. It forms when a large red candle swallows the previous green one, showing sellers have taken full control and buyers are trapped at the top. Each of these patterns works best when you combine them with clear structure. If you see a bullish engulfing near a previous low that aligns with Fibonacci retracement or trendline support, that's not coincidence, that's confluence, and confluence is what gives traders confidence. But a pattern without context is a trap. Many new traders lose because they trade every hammer or shooting star they see, forgetting that the candle only matters if it forms at a significant level.
The real skill is in patience, waiting for the market to come to your zone, letting price show rejection or confirmation, and then entering with discipline. Remember, trading is less about prediction and more about reaction. Your goal is not to be right about the next candle, but to align yourself with high-probability reactions when the market shows its hand. The psychology behind this is simple yet deep. When the crowd panics, professionals prepare. When the crowd chases, professionals wait. The rejection candle tells you when that shift is happening. The hammer or inverted hammer at a support zone tells you that buyers are defending that price. The shooting star at resistance warns you that buyers are losing control. This is not magic. It's market logic. Combine it with risk management, and your edge compounds. Always place logical stop losses just beyond structure, never emotionally. A small, smart loss protects you from the big, stupid ones. Also, understand that candles change meaning depending on the time frame. A bullish candle on a 5-minute chart could be a bearish wick on the hourly. That's why top traders always confirm signals on higher time frames before entering on lower ones. It's like checking a weather forecast before stepping outside. Price action is a story, and your job is to read the story, not rewrite it. When you see a series of higher highs and higher lows, that's an uptrend. Buyers are consistently stronger. When the structure breaks and a lower low forms, it's a warning that the narrative might be changing. Candlestick patterns are the sentences within that story. Together, they build meaning. The mistake most traders make is thinking more trades equal more profit. In truth, the best traders make fewer but higher quality trades. Overtrading, revenge trading, and FOMO, fear of missing out, are psychological traps that kill consistency. The market doesn't reward emotion. It rewards patience and precision. If you miss a move, let it go. another opportunity will come, but your capital must be alive to catch it. Technicals like the bullish engulfing or morning star give you the entry logic, but psychology gives you the longevity. Even when your setup is perfect, expect uncertainty. A perfect candle can fail if market sentiment suddenly shifts due to news, liquidity, or manipulation. That's why professionals don't aim to win every trade, they aim to follow their plan perfectly. When you combine price action, candlestick psychology, and proper risk-reward ratios, you create a system where losing trades are small and winning trades are large. Over time, probability works in your favor. Think of every candle as a negotiation between buyers and sellers. A long wick shows rejection, a small body shows hesitation, and a full body shows conviction. Learn to see these emotions, and you'll never trade blindly again. Study your charts, draw key zones, mark where candles show clear rejection or engulfing, and wait for confirmation. Respect the trend. Use the candle as a guide, not a guarantee. Most of all, control your emotions, because in trading, the real candle you must master is the one that burns inside you: your patience, your discipline, and your belief in your process. When those align with price action, your trades become powerful, not because of luck, but because of logic and psychology working together. That's the true art behind reading candlestick patterns, not memorizing shapes, but understanding the behavior they represent and how it connects to market structure. Once you learn that, you'll realize trading isn't about predicting the future, it's about interpreting the present better than everyone else.